Welcome to the last module for financial institutions and management. In this module, we cover other financial institutions besides banks. This includes savings and loans or savings institutions. Sometimes they're called thrifts, credit unions, finance companies, investment companies, or mutual fund firms, and securities firms or brokerage firms. This is intended to be a very brief highlight of these other institutions. I want to emphasize that you need to study the textbook for the definitions and the detailed operation of all these different types of institutions. There are important details in there. In this lecture, what I hope to do is to highlight the differences and the similarities. So I'm not going into the specific details, so you need to read the textbook for those details. But what I want to do is to draw a large picture, in other words, take a step back and say and look at all the different institutions that we have studied. We have studied banks, which was the focus, and then how are these other institutions differed or similar or are similar to banks. Savings institutions are actually very, very similar to banks. They are thrifts, and they have served a very important function. One thing that is distinct or unique about savings institution in contrast to bank is that some savings institutions are called mutual. So, and they'll have the name mutual in, they'll have the word mutual in their name. Banks, by definitions, are all stock-owned, meaning that the banks are constructed as a corporation. Some banks start off as partnership, but almost all banks nowadays are corporations. So what distinguishes savings institutions or savings and loan or thrifts is that some of them are considered mutuals. And in the mutual ownership, the institution is owned by the depositors. So what makes that unique is then the interest that is earned by the depositors is actually a function of the profitability of the institution. So when you join a savings and loan or savings institution that is a mutual ownership structure, you, the depositor, automatically becomes part owner of the institution. So because of that, they tend to be smaller than commercial bank, and most of them are regional or very local. As you see, since the depositors are also owners, they form a much stronger community, and they have a say in the operation of the savings institutions by the ability to elect board of directors. The main source of fund, meaning the liability of the savings institutions, are deposits. And the main use of funds are mortgages and commercial loans to small business and property loans and business operation loans. Many savings institutions have lately merged with commercial banks over the years, and some of them are not as small anymore. So they may start as a small local firm, but through mergers and acquisitions, they have become much bigger over time. This is particularly was true since the 2000s, where some savings institutions was very aggressive in pursuing and expanding their strategy, their business strategy to expand across geographic location and also across industries. The financial crisis and savings institutions have gone hand in hand for many, many years. In fact, because most savings institutions and savings and loans invest very heavily in mortgages, and back in the 70s, they were very local and regional. They were subject to much higher default risk than other types of financial institutions. They have gone through several financial crises. Back in the 1980s, after deregulations allow savings institutions to make much more risky loans and investments, those change in regulation led to higher risk loans given by savings and loans and institutions, and also in the 1980s, short-term interest rate increased dramatically in order to fight inflation of the late 1970s. This there were a lot of losses and bankruptcies among savings and loans. So the industry suffered heavily during that time. And as in any case, whenever there is deregulation, you will see cases of frauds. This, unfortunately, since the 1980s, deregulation continues, and savings and loans, once they have emerged from their last losses, they re-engage in the same lending, because that is their primary business. The primary business of savings institutions is mortgage lending. So once again, in 2008, when the financial crisis centered around mortgage defaults, savings institutions were one of the major victims of the financial crisis. Now, they were also part of the participant, but they also bear a lot of the bad outcomes. So when I say they are victims, they actually were also a heavy participant, because they led the wave in subprime loans and also mortgage loans that requires no documentation. They're called no-doc loans, and they led to a lot of mortgage defaults, and the loans that, and of course, that led to heavy losses by financial institutions. So some of the most famous or notable failures include Countrywide Mortgage, Countrywide Financial. They were one of the largest mortgage underwriters in America back in the 2000s. Eventually, they were acquired by Bank of America. They were literally in bankruptcy when Bank of America acquired them. IndyMac is another large savings institution, and it has a portfolio of $32 billion in loan, and it lost most of it during the financial crisis. Washington Mutual, notice that the name Mutual is the name Washington Mutual includes the word mutual. That means the depositor is part owner of this firm, but WAMU is one of the largest depository institutions. Back in the 2000s, they pursued a very aggressive expansionary policy, and eventually they failed in 2008. And their failure, the notoriety then becomes that they become the largest depository institution ever to fail. So savings and loans has a long history with financial crisis, primarily because they invest heavily in mortgages, and when during housing bubbles of the 70s and the housing bubble of 2000 in the 2000s, in both cases, savings and loans suffer greatly when mortgage defaults. Another type of institutions that are very similar to banks and savings institutions are credit unions. Credit unions is organized as a nonprofit. So, and they need to have a common theme. This common theme is not very strict. So you can have a credit union that is based on a belief. So you can have a church, for example, the Lutheran Credit Union. You can be affiliated with a university or a local area. So the important, how can you tell something is a credit union is in the name. The name of the institution has to have the words credit union in it. For a lot of consumer, it is difficult to distinguish between a bank, a savings institution, or a credit union, because all of them accept deposits and all of them allow consumers to take out loans. It is important because of how they are regulated and how investors are, how your deposits are being treated. So in a credit union, is because it's a nonprofit, it is technically owned by all the depositors. So very similar to a mutually owned financial savings institutions. For credit union, similar to savings institutions, they can have a federal charter or a state charter. If it's a federal charter, just like banks as well, then it's regulated by a federal bank examiner. If it's a state charter, you'll be regulated by the state agency. The advantage of being a credit union is that because it is a nonprofit, it is not taxable. And Now, this is the tax exempt status extend only to the credit union itself. The interest income that is earned by a depositor from a credit union is still taxable, but the credit union itself, there's no income because it's a nonprofit. And most importantly, a credit union, the non-interest expense is typically relatively low because their office and furniture are often donated, or that if you go to a credit union, is typically a no-frill operation. So they are really their purpose is to serve the members. Particularly, they're typically small, and the disadvantage of being small is that it's difficult for them to attract highly qualified professionals. So they suffer similar issues that face other nonprofits. So they tend to be small, and it's difficult to get good people to run these operations. So credit unions, unlike savings institutions and banks, is insured by a different organization. So 90% of the credit unions are insured by the National Credit Union Share Insurance Fund, so not FDIC. Notice that credit unions are not banks, and they are not deposit institutions, so they are not insured by FDIC. Credit union typically pay an annual insurance premium. So similar to banks, they have to pay a insurance premium to FDIC. And in case of default, the NCU will then reimburse the depositors of a credit union. So for federal credit unions, they are regulated by the Federal Credit Union Administration. And for state charter, they have each state has their own agencies. So the examiners typically classify credit unions into either low risk or go 1, 2, 3, 4, 5 to high risk. So depositors can look into the rankings of their credit unions before you choose one. So credit unions, they are still significant. They're small in size, so typically they do not bear or have too much impact on systematic risk to the economy as a whole. Depositors still need to pay attention to the risk of their relative credit union.